Hello and welcome to the AIM Summit webinar on converging crypto and capital markets. Here with Tyler Winklevoss, one of the co-founders of Gemini, and Fred Pai, the chairman, CEO of 3iQ. I'm your moderator, Zachary Sefaradi, CEO and founder of Dalma Capital. We have so many people participating today from around the world, over 65 different countries joining us. Amongst you are institutional investors, family offices, high net worth individuals, and leaders of the financial services industry. This will be an interactive session. Feel free, at the bottom of your screen, you will see a Q&A dialogue. Submit your questions as they come throughout the session. We're going to be starting off with a fireside chat, but feel free to fling us questions. We're going to be addressing those towards the end of the session. Introducing our webinar partner today, that is 3iQ, founded in 2012. 3iQ is a Canadian investment fund manager focusing on providing investors with exposure to digital assets, disruptive technologies, and the blockchain space. 3iQ was the first Canadian fund manager to agree terms and conditions with the Canadian securities and regulatory authorities to manage a public Bitcoin fund and multi-crypto asset fund for Canadian accredited investors. Access to these new technologies can be daunting, costly, and inconvenient, but 3iQ has worked out a stringent regulatory process to offer investors a convenient and familiar investment product and solution to gain exposure to digital assets. We're going to be discussing today a variety of topics focusing on the benefits of Bitcoin and other crypto exchange traded products, or ETPs, for institutional, retail, and wholesale investment. We're going to be talking about conventional market infrastructure, how it is enhanced digital asset exposure from custodians, liquidity providers, market makers, and transfer agents. We're going to be talking about the benefits of multi-jurisdictional listing and understanding the recent surge in institutional adoption. I'd like to start with the recent surge in institutional adoption, but actually before we get into that, I think, Tyler, you have a very interesting history coming into crypto. I did give a brief introduction to 3iQ, but do you mind telling us a little bit about your journey into crypto, into Bitcoin, and your journey with Gemini since founding it several years back?
Sure. Thanks for having me, everyone. So my brother Cameron and I, we discovered Bitcoin in 2012 on vacation, of all places. And we actually bought a lot of our early Bitcoin on Mt. Gox. That was a very scary experience. It really informed us of what was lacking with the infrastructure. And a few years later, Mt. Gox famously imploded. And we looked to invest in exchange custodian platforms to build a new wave for users, but we really couldn't find anyone who really believed in regulation, security, and licensing in addition to products. So at some point we decided we'd have to go build this ourselves. So we picked up the phone with the New York regulator, New York State regulator, the New York DFS. Asked them how to get a license, went through a 1.5-year licensing process, and then finally launched in 2015 with a more institutional grade exchange that could service institutions, but also individuals. And we've been on that journey now for almost seven years. And it's been really interesting to see the different waves of crypto adoption. Obviously, 2017 was a really interesting cycle. The price ran up. And institutions got close, but I think they weren't quite comfortable to jump into Bitcoin in the land of crypto. And then this recent wave, though, we've definitely seen institutions come in. There's institutional grade products like 3iQ to help them. We've seen companies take Bitcoin on their balance sheet. We've seen legendary hedge fund investors put their money into Bitcoin. So this wave is the first time we're really seeing the institutional support there, and we built Gemini to be ready for when that came, and we're happy that phase is now here.
So, following on that discussion, so we've seen a wave of institutional investors coming into the space, again, with organizations like Gemini having really done the hard part of setting the foundations, going the extra mile that a lot of the early guys in crypto were not willing to do. Actually, I remember in the early days, I first bought Bitcoin in 2011. Unfortunately, I didn't double down or go in as big as you and your brother did at that time. But we at Dalma Capital have also been working in the asset class for I think 2015, 2016, also focusing on institutionalization of the asset class. And in those days, people thought you were crazy. A lot of the exchanges were saying, "Why would you deal with all of this? It's better to not be regulated. It's better to be offshore. Set up in the Seychelles or where nobody asks any questions." But those of us who have taken the bigger picture view of looking to institutional investors is eventually bringing in another wave of this asset class, are now seeing that institutional adoption come to fruition, maybe a little bit later than a lot of people expected, but now really coming in mass. So Fred, your organization has been working closely with a lot of institutions. You recently announced your strategic growth and partnership with NASDAQ Dubai into the region and into the Middle East. What are financial institutions, institutional investors, what are some of the key characteristics that they look for, and how might those differ from retail investors in terms of gaining comfort with the asset class or a product that gives them exposure to the asset class?
Well, first of all, Zach, I'd like to say that we are working at 3iQ to try and give the facility to have Bitcoin trade 24 hours a day in what we consider a regulated platform. What we have found, but with what 3iQ achieved in Canada and having a regulator do 4.5 years of due diligence to get the product right, and that's the way we look at it, we got the product right. It really is the fiduciary responsibility of boards of directors, of pension funds, of people working for family offices, of investment advisors. It's really their fiduciary responsibility to get it right and to make sure they've done their homework, to find the right custodian, make sure the pricing is correct, make sure there's not market manipulation, make sure that it's auditable. So all of these things are very different in a packaged product, as opposed to them. An investment advisor isn't going to go out and open up 600 wallets for their clients and try and manage those. So we really were the first that brought all of this into the regulated framework. And a lot of that had to do with the hard work that we had to do. And, we consulted with Gemini very, very early on in our process. And it's very strict in Canada to have a foreign custodian. It's very strict what the rules are. So, while we were working through all of this, we were trying to get watching Gemini as they had to get over $100 million of equity capital. We had to have their SOC 1 reports done, their SOC 2 reports done. And a lot of this is technical, behind the scenes type of stuff. But Gemini got their BIT license, got their trust license, and we were just rooting with them and cheering them all the way. So finally, when we did get to the public hearing in Canada, we had great support from Cam and Tyler in terms of standing up to the regulators. And we ended up with what we consider the best type of product. But since we have this in Canada, from all around the world, the institutions are now calling us saying, this is what we've been looking for. It's about time we have something of this type.
So both 3iQ and Gemini, I think, would be fair to describe as institutional grade. You were set up to withstand the due diligence of the demands, the requirements of financial institutions, but you are crypto native firms in the sense that your focus has always been to work in crypto products. How are you seeing other financial institutions that are not crypto native start to look at the roles of custody, liquidity providers, market makers, transfer agents, some of the other intermediary responsibilities? Again, Fidelity is a well-known player in this space. But Tyler, what are you seeing on the ground in New York City in terms of other financial institutions start to take up the roles, and do you see them as competition, or do you see that as a validation of crypto? What's your kind of view on this and how it's playing out?
I think that that crypto native, but more importantly, technology first companies, that's what Gemini is, and I think that's what you need to be able to succeed long term in this space. Simply being a financial institution that's tech enabled is just not the same. And the landscape moves so fast that you have to be able to innovate at the speed of of innovations. So it's tough. I think it's going to be tough. I think it's ultimately tough for incumbents to sort of change their stripes and keep evolving, because if you look at the space, when Gemini started, we just had Bitcoin. Ethereum was launched, but it really didn't pick up traction and was viable that we could sell to regulators till about 2016. And then comes DeFi. And then there's the NFT movement. If we were having this conversation literally a year ago, we wouldn't be talking about DeFi and we wouldn't be talking about NFTs. And I know that's sort of maybe beyond the scope of the conversation, but the landscape moves so fast, and Gemini is got the human capital, the technologists, the security, world-class security engineers to keep the Bitcoin, or Bitcoin, Ether, and other crypto safe. And we can move at the speed of the marketplace. And ultimately, we're very much a platform company that speaks to protocols. And there's no experience before crypto of engineers that understand how to secure Bitcoin and Ether or talk to these protocols. And these protocols are constantly evolving. They have communities, and we have to keep pace with that. So that's sort of like the pitch for companies like Gemini or even a Coinbase. I think we're crypto native companies. We are seeing a lot of banks try and get access to crypto for their customers. I think a lot of their customers feel left out. They've seen Bitcoin is the best performing asset of the last decade. It's on track to be the best performing asset this decade. I think Ether is neck and neck with it. But these assets have absolutely blown away the equities market, the FANG companies, like the best of the best. And Wall Street banks still have not provided their customers with a way to access it. I think funds like 3iQ provide that bridge. And I think it's pretty important also that we worked very hard at Gemini to be a fiat on-ramp into crypto. So a lot of these exchanges that are offshore you can't wire your cash in. You can't add your debit card. You can't ACH money in because they're not regulated. They're not licensed. And so we've made it easy for you to basically take your existing bank account and get it into crypto. And funds like 3iQ are super important because a lot of the largest money in the world needs to buy a security to get access to this. They just can't hold crypto itself. And so that's a really important on-ramp. They also need to work with regulated partners. We're a New York trust company. We get examined by bank examiners. 5 examiners come into our office for over a month every year. We do internal audits. Like Fred said, we're SOC 2 and SOC 2 type 2 and SOC 1 type 2 compliant. We do security penetration tests and all of these things to build that bridge between Wall Street and this new land of crypto. So there's a ton of excitement. We have market makers. There's a lot of interesting hedge funds that have been in crypto for a long time. So it kind of depends on the type of money. A lot of family offices have been there early, the principals at hedge funds. But like I said, we're really seeing the institutional adoption. Tesla's got Bitcoin on its balance sheet. Square has got Bitcoin on its balance sheet. Some of the smartest, biggest visionary entrepreneurs, some of the best companies in the world are now seeing this as a treasury asset that is superior to cash because they are worried about all of the money printing that has been happening. And ultimately, Bitcoin is the hardest, soundest money in the world that we've ever known. Much more so than gold. And I'll just quickly go down the line there. Gold's scarce. We don't know its ultimate supply. And 2/3 of above ground gold has been mined since like the 1950s or 60s. So it's actually unbounded. Bitcoin is fixed. So it is the best hedge to the oncoming inflation that we all know is here and coming. And Cameron and I wrote a blog piece to this effect this summer, talking about how Bitcoin is a superior hedge to inflation over gold, over oil, or any other asset we know. There's no technological breakthrough that can increase the supply of Bitcoin. We saw fracking with oil. If the price of gold goes up, it becomes more profitable to mine. And so Bitcoin across the board is the ultimate hedge to inflation. And we actually think if that's the case, then, and you look at the characteristics of gold, why people think gold's valuable, Bitcoin matches them or beats them. So it's really gold 2.0. And if that's the case, it has to disrupt gold. And the market cap of gold right now is 10 trillion. The market cap of Bitcoin is 1 trillion. So there's still potentially, we think, at least a 10x from here. But Bitcoin's obviously much more than gold. It's an open source money network. It's ultimately the greatest social network of all time. And I think, I believe strongly about Ethereum being the world's digital computer and Ether being digital oil that purchases compute power of that computer. So I am very bullish, as you can see, on both of these asset classes. And I think it's really critical that there is now access paths for institutions who need to come in through a fund that's highly regulated and get exposure through a security that was missing. And I'm really glad that 3iQ is the first fund issue in the world to actually give that product, bring that product and access to the world.
It absolutely has been an exciting time for 3iQ, and we've seen, again, a lot of organizations seek to follow in its footsteps. Certainly has been validating this wave of adoption, but again, a lot of crypto natives and early adopters would argue that the access products, exchange traded products, kind of undermine or contradict what Bitcoin was all about. That Bitcoin was all about cutting out the middleman and people being able to custodize and hold Bitcoin themselves, and the not needing financial institutions, financial intermediaries. I mean, Fred, how would you respond to those who think that exchange traded products are actually undermining what the idea or nature of the Bitcoin project was? Is that a contradiction that you would disagree with, or do you think that there's a bigger picture that people should focus on?
Well, obviously, as a Bitcoin, shall we say, a pseudo Bitcoin maximalist, because I am a fan of Ether, but for Bitcoin and what its uses were, even though we have created the type of product which we store at Gemini, I believe that people that are real believers in Bitcoin should have their own Bitcoin wallet, and they should carry it. But early days, like 5 years ago, 7 years ago, we were concerned about traveling into the US with $10,000, more than $10,000 in my phone in Bitcoin, because we were hearing stories that if you say you're in the Bitcoin business, they'll check your phone. And if you're moving more than 10,000 across the border, you had the possibility of having it confiscated. So, so we've seen the world develop. I think everybody needs to have a wallet. Everyone in the world should have a wallet, but that's completely separate than what is your asset allocation to a scarce asset as part of a diversified portfolio. And I'm not saying it's Bitcoin over gold. I'm thinking if you're a responsible investment advisor, you have Bitcoin, you have gold. Clearly, Bitcoin has been superior in terms of its performance, but that could possibly change at some point down the road. The reality is scarcity of assets when you have a rampant money printing are in high demand, and I think that we have to maintain that kind of position. We're obviously very proud that we were one of the first in this space to do that. So we think that it's not one or the other. People should all embrace digital assets. They should have a wallet. And we're going to wait till later where we can start to grill Tyler about his NFTs and his operations. But right now, certainly the first step for investment advisors to understand Bitcoin and understand how powerful a regulated product we've created that allows them the safety and security that they're looking for when they invest in Bitcoin for their clients.
So, Fred, you mentioned a few times investment advisors. So we talked a little bit about institutional investors coming into the space. Tyler referred to some corporate investors who come into the space. Now, two questions. When I think of institutional investors, I think pension funds, I think sovereign wealth funds. Where are these guys in terms of adoption? Are these market participants starting to show interest? Are they building positions? Are they yet looking at this as a treasury asset or even as an asset class? This is a question I'd like to ask both Fred and Tyler, but maybe we'll start with Fred. And then you mentioned financial advisors. A lot of people, a lot of high net worth individuals rely on financial advisors to help them allocate their wealth and savings to different financial products. What is the importance of the wholesale market that sits behind financial advisors for exchange traded products, and why are exchange traded products a key component of those financial advisors being able to have their clients have some of their wealth invested in Bitcoin?
Well, certainly end clients, they look at their statement, they look at their performance, and having Bitcoin packaged as a security, which is what the Bitcoin fund is it's a security that owns 100% Bitcoin. They can now see it as terms of their asset allocation. And anyone who started with a 1% position is already over 6 or 7%. And so we do see a lot of people like reducing their exposure. A lot of the banks and the investment dealers are still preventing their clients from having more than a 2% position in Bitcoin, and so the clients are revolting. But I think what we saw a very few sovereign wealth funds or very few pension funds get into Bitcoin. But it's clearly obvious in the $40,000 to $50,000 range here that when we dip below 50,000, it does give an opportunity for a lot of these people who have watched Bitcoin mature to the level that it is. I think the fact that Canada has the closed-end funds, and now as we have our ETFs, people are looking forward to saying, okay, now I can legitimately, legally do it. The liquidity, the trading is sufficient at this stage. And the costs have come down. But, as we said in the beginning, 3iQ, when it originally started in 2012, was an investment management firm. It quickly shifted in 2014-15 to a digital asset firm where we had to learn about the technology stacks behind everything we were doing. We had to understand the cybersecurity, the cryptographies, and everything behind what they're doing. We had to understand Gemini's processes of cold storage. We had to understand the insurance policies and things behind Gemini's products. And so all of that homework that we did, the 10,000 pages of testimony with the Ontario Securities Commission, provides good due diligence for a sovereign wealth fund, for a pension fund, for the largest family offices in the world to now say, okay, now we can dip our toe in. We know somebody's actually done their homework really well. And that's what we did.
So touching upon the institutional investor question, I mean, Tyler, you mentioned some of the institutional investors that have been coming into this space recently, but what are we seeing? I mean, again, when I think of institutional investors, the guys who write the big checks, the guys who can really move the needle in an asset class, I think of pension funds. I think of CalPERS. I think of the national pension funds of South Korea, Japan, Canadian pension system. Where do you see these types of investors, sovereign wealth funds, the Abu Dhabi investment authorities, the China investment corporations? Are they yet comfortable building position? Are they studying it? I imagine that you must have some visibility on the Gemini platform as to whether these investors are starting to adopt this asset class or whether they remain yet to come.
Yeah, so the way I'd characterize the sovereign wealth funds and some of that big money is that they're highly sophisticated on this asset class, much more than you may even imagine. And it's not just they started studying up this year. They've been watching it. And so I think they're a lot closer than people would imagine. What I'd also point out is there's about 40,000 publicly traded companies around the world on global stock exchanges that are regulated. I think only 32 have Bitcoin on their balance sheet. That number is going to increase over time. You're going to see the Fortune 100, 500, 1,000, they're all going to have Bitcoin on their balance sheet. So when we think about like where Bitcoin is today, I think it's the second pitch of the first inning. I mean, it's really early. If only 32 companies have this, and we know that number is getting bigger. At some point, a central bank will have Bitcoin on its balance sheet. That just will happen because central banks have gold on their balance sheet, and Bitcoin is gold 2.0. And it's not, in my opinion, it is not an if, it is a when that a sovereign wealth fund comes out and says it has Bitcoin. They may already have it. I would not be surprised. I also think that there are endowments and pension funds that have exposure to crypto, either through funds or slightly indirectly. But I've talked to a lot of endowments. I've talked to a lot of sovereign wealth funds over the years. And I guess I would say, like, you'd be shocked at how sophisticated and knowledgeable they are in the asset class. And I truly believe it is a when, not an if question. And we built Gemini for that day. Institutions like 3iQ are helping bring that day even closer. So I do think you have a world where every company, private, public companies, are putting Bitcoin on their balance sheet. You've got sovereign wealth, you've got endowments, and you've got even central banks as well, because it's just, they've already been doing this with gold. And everybody recognizes that Bitcoin is a better version of gold. So as Elon Musk says, it's only inevitable.
Well, and I mean, again, you refer to Elon Musk. Tesla is around 1.6% of the S&P 500. Anybody who has an S&P 500 linked ETF, which is pretty much, one of the most popularly traded and held products in the world, technically has some exposure to Bitcoin now via Tesla and any other constituents that have some Bitcoin on their balance sheet. So for any investor, there is a little bit of exposure out there, but right now, again, we're talking about such a small exposure. It's hard to imagine that isn't going to grow. And as you said, we still remain in the early innings. But thinking of the mentality of sovereign wealth funds, I mean, we've seen, again, the Norwegian sovereign wealth fund, for example, get rid of a lot of active management and move to exchange traded products across their portfolio. Do you think that exchange traded products will be a popular way of gaining exposure for sovereign wealth funds, for large institutions, or do you think that they might hold their Bitcoin directly through their own wallets or through third-party custodians? Again, they do tend to be very fee sensitive. So how do you see a pension fund, sovereign wealth funds potentially building exposure once they decide they're going to take a position?
Yeah, I'll answer that. What we see is obvious request for discretionary management. For example, people are saying that we'd like you to manage our $100 million position in Bitcoin. Obviously, you can negotiate better fees. We'll take the screwdriver and try and negotiate some better fees with Gemini. And try and get clients of that size a reasonable cost for keeping it. But again, with their fiduciary responsibility, nobody wants to be responsible for losing the private keys or losing the processes or having a disgruntled employee leave and not have all your policies and procedures. Policies and procedures are very in-depth in managing a regulated portfolio. And I think that is key. But second is the auditors. We were very fortunate to have our CGT of Montreal, which is a division of Grant Thornton, that had a specific blockchain audit capacity through a company called Cadillac C. And that was one of the reasons why we actually got the first product, is because We had been running our multi-global crypto asset fund for over 3 years, or when we started it over 3 years ago, that fund had to be audited. So when we testified at the Ontario Securities Commission, we said, here's a viable, proven audit that's been done on this. And Gemini helped with us get that audit done, which wasn't easy the first time. We had to move money back and forth and Bitcoin and crypto back and forth. One thing I will tell you, Zach, is that the whole world is waiting for these institutions to announce that they own Bitcoin. That's not going to happen. So some of the biggest pension funds that we're talking to in Quebec would make us absolutely swear to secrecy if we were managing a portfolio for them, because they still consider there's some, tail risk, in terms of if something dramatic. Bitcoin has had 3 corrections of 90%. Nobody wants to hear that their provincial pension plan or federal pension plan or company pension plan owns an asset that's down 90%. So as it matures, they'll be very quick to say that the reason our portfolio is up 17 instead of 5, for example, is because we had a 10% position in Bitcoin. But we're not going to see that. If the world is expecting, and I know a lot of the journalists are, which is, we're not on with journalists, we're on with our team here. A lot of them are waiting for that big next Elon Musk. Oh yeah, we're in it. You're not going to hear about that. Responsible money managers will do their jobs responsibly, have an alternative asset bucket, and this will be a piece of that alternative asset bucket for sure.
So, going back to the institutional adoption that we've seen in crypto. I mean, we discussed how this has really been driving a lot of this wave. I think there's a lot of kind of belief that the price action that we've seen over the last year, which has been obviously extremely robust, is largely driven, at least on the demand side, by this wave of institutional adoption announcements, like, again, Tesla coming in and buying a significant exposure of Bitcoin. Now, again, Tesla selling cars for Bitcoins, or as Fred likes to clarify, they're actually buying Bitcoins with Teslas. That is clearly a major factor. But the explosion in asset prices across multiple asset classes and sectors has also been driven by monetary policy actions by the global central banks. And this seems to have had an outsized effect on Bitcoin. I'd like to maybe ask Tyler, what is your view on the extent to which the monetary fiscal policy action has stimulated the price of Bitcoin, and why might it have done so more than for gold or for other asset classes that tend to be that kind of inflationary or money printing hedge?
Yeah, no, I think that is the question. Anyone who's been paying attention to the Fed's balance sheet, even for the 10 years prior to COVID, has seen it's been rapidly expanding. And so we've been printing money like crazy in the US, and I don't think we're alone in terms of fiat regimes. And then enter COVID, the lockdown, the entire economies of the world shut down, and we resort to the same the Keynesian tools to get us through the lockdown and the pandemic. So we print even more money. We basically press the turbo or smash the turbo button even more. And so people are looking at the debt to GDP ratios. So in the US, it was recently 135%. That's higher than it was during World War II. There's actually a big difference though, because back then we had full employment and record production for the war effort. This time around, we have a higher debt to GDP ratio percentage. We had record unemployment, and the world's production grinded to a halt. So anyone who tells you, oh, this is normal, we just print money and get our way out of this, is just not looking at the facts. We're in completely uncharted waters. Debts, the world is awash in debt. The ratios and the debt mountains are ballooning across the world, and every fiat regime, Europe, UK, US, China, Asia, you name it. So it doesn't take a rocket scientist to see what's happening in these fiat government currency regimes. People are absolutely scared and terrified. And a lot of the people that we were talking to in 2017, 2018, that got close to jumping into Bitcoin, but didn't, came running back. As soon as there was the huge, I think it was in March when, at least in the US, financial markets absolutely melted. Everything went down. I don't know what day that was, but we all kind of remember it. And we're like, is the world over kind of thing. And then as soon as that came up and people got above, their heads above water, could breathe and sort of look around, all of those folks, like the dyed-in-the-wool Wall Streeters, the biggest Bitcoin skeptics in the world a few years ago, came running to Gemini and said, how do we buy Bitcoin? You don't even have to tell us, like, pitch us on it. Like, we're bought in. We just want to know how do we get this quickly? How do we open an account? Boom. So they're just seeing what's happening in centralized finance, in the fiat currency regimes. They're doing the math. They're looking at the Fed balance sheet. They're looking at the stimulus packages. It's simple arithmetic. I mean, there was a time in the early 90s when Ross Perot wrote on, he was a candidate in the US to balance the budget. The debt's out of control. That was in the 90s. Like, we've run a budget surplus in the US 4 years out of the last 50 years. It's not getting better. People are doing the math, and the what it costs us to service our debt burden is spinning out of control. It's compounding against us. And the question is, like, can the US ever make good on any of this, and other countries as well? So that has been a massive motivator. We were on the front lines of it with Gemini. A lot of these customers came, and I think that's why you're seeing funds like 3IQ be such a massive success, because people are looking for alternatives. They want to hedge from the current system, and they're absolutely worried that with the way that the money policy and the stimulus have been managed, not just through COVID, but actually you got to look back to 2009, 2008, actually.
Well, certainly in this year, we've seen possibly the adoption of a new permanent stance on macroeconomic policy from central banks. Again, the Federal Reserve has moved to a flexible average inflation targeting regime, which allows inflation to run up above 2% for potentially extended periods of time. We've seen the kind of central banks of the world start to validate modern monetary theory, which for many people, particularly classical economists, is a scary thought. Again, you weren't sure what date. It was March 23rd of 2020 that the Fed started throwing haymakers, right? It was unlimited QE, whatever it takes.
QE infinity. Powell's already said that he's spiking inflation higher. The Fed's already announced basically a soft default, and so higher inflation's happening. And also, like, how people measure inflation, it's not CPI. Like, look at the asset prices. I think it's measured incorrectly, and I think it's been here for a long time. And the scourge and tidal wave of it is only going to continue to come.
100%. I couldn't agree with you more. Again, we use CPI, we use consumer prices, but consumer prices are all deflationary. Technology has been, I mean, look at the cost of harvesting an ear of corn has increased several thousand-fold in terms of the amount of capital and labor that it takes to harvest that. So the components of CPI are illusory. They're good for consumer prices, but at the same time, we're sitting on the side of the street and we're watching asset prices. Whether it's the stock market, whether it's residential real estate, commercial real estate surge. We're wondering, why is the Fed telling us there's no inflation? Talking about central banks, there's an interesting question from Sandhya DeMello, senior reporter at Khaleej Times here in Dubai. She has asked, what will the role of central banks in the future of CBDCs? When will that evolve in greater scale? CBDCs are central bank digital currencies. Is that a potential competitor to Bitcoin? Or is that another potential on-ramp, as Tyler refers to, into the ecosystem? Maybe Fred can start on that question.
Yeah, and CBDCs are definitely going to become a reality. I mean, and we've said that since the beginning. And when people used to say, oh, Bitcoin's not money until you can go to Starbucks and spend Bitcoin to buy a coffee. Well, you're not going to Starbucks with a bar of gold to buy your coffee either, right? It's just store of wealth. You're not using that for day-to-day transactions. But if you have to move $500 million around the world instantaneously, securely, and virtually for free, you'll use Bitcoin. Now, having said that, we believe, and we wrote a white paper a couple of years ago with a company we started, Canada Stable Corp. We own a digital Canadian dollar. And the point is that all fiat currencies will have a digital representation. Now, will they be governed by the central banks, or will they be governed by the banking system? My view is a digital Canadian currency, if it's not held as deposits in Canadian banks, and it's held at deposits in the central bank, that displaces Canadian banking system. The Canadian banking system is not broken, so we don't expect to see a digital Canadian dollar that's held by the central bank anytime soon. However, you know, one of our business partners here in Canada, VersaBank, when talking to the financial people, they said, remember when we, in the 70s and 80s, when we were backpacking around Europe, what did we use for money? Well, we used American Express travelers checks. And they said, yeah, of course we all did. So what is a stable coin? Well, it's a digital representation of a deposit at a bank that you can now spend anywhere in the world. And that's what you're going to see. So it's kind of like the first, stable coins will actually be digital representations of bank deposits, as opposed to necessarily central bank issued currencies. But you'll see in places like Barbados or Bermuda and stuff like this, movements to move that, but their currencies are pegged to the US dollar, to other central currencies. So you're going to see all kinds of developments in that space, but that's the DeFi space that Tyler was referring to. These stable coins have to be built on a blockchain platform, and that blockchain platform could be Bitcoin, it could be Ethereum, it could be Algorand, it could be Tezos, could be any number of different blockchain platforms. But money is going digital in our lifetime, and your exposure you have to start your exposure to that space. And whether you started in Bitcoin and move to Ethereum, then that's the way you certainly should start. I want to jump back a couple of seconds on, and I love your March 20th date, because that was the day we actually were just launching the original Bitcoin fund after 4.5 years of negotiating and getting the right product. We said, what could possibly go wrong? Well, in our risk box, we didn't check off global pandemic and a market collapse. So Bitcoin fell to $5,000, but Bitcoin recovered remarkably fast with unprecedented volume and momentum. And the reason being, and one of the biggest factors for buying Bitcoin is not correlated to anything. It doesn't care about nothing, doesn't care about NASDAQ, doesn't care about, political events or anything along those lines. And in the early days, both of you would remember, anytime North Korea launched a missile that went over the south of Japan, massive Bitcoin buying would come in from South Korea and come in from Japan, as people using Bitcoin as their store of wealth, as their flight to safety instead of the US dollar. So Bitcoin is a beautiful non-correlated asset class that can be both risk on and risk off. Right now, it's hard to argue it's not a risk on asset right now because of the freedom of printing money. With all the freedom of printing money, people are acquiring those hard assets like Bitcoin, and that's why we've got such a great price. And again, we expect it to continue.
So Tyler, I'd like to maybe ask you a little bit about your view on stablecoins. There are a couple of other questions from the audience, including one from John Trammell about digital competitive entries from national governments like the digital yuan. And he mentioned that some were used to pay salaries recently. I think he mentioned JD.com. I know that you've been both active in Bitcoin and Ethereum and traditional cryptos, as well as stable coins. What do you see as the potential role of CBDCs? Are these a competitor to the ecosystem or another on-ramp?
Yeah, no, I think it's another menu option. To compare a stable coin or any government currency that is put on the blockchain to Bitcoin, it's it's apples to oranges. It's like the dollar doesn't disrupt gold. They perform very different purposes in a portfolio. I think of gold as a store of value. And I think store of values are things you want to huddle in the parlance. You don't want to spend because they will go up. And I think of currencies, things I want to spend, as things that are losing their value over time, hopefully not too fast. And so if you put dollars in your mattress, you will lose your purchasing power over time. And so you want to spend currencies that are somewhat stable, that are depreciating in value. Bitcoin, even shares in great companies. You don't want to sell your Amazon stock to buy a cup of coffee. You don't want to sell your gold. You don't want to sell your Bitcoin. They're opposite ends of the money spectrum. And so I don't think that just like the dollar is not competitive to gold, I don't think a CBCD or a stable coin is competitive to Bitcoin. They provide different, very, very different services. And ultimately, I think the governments are their own competitors. I mean, how many national state currencies default every year, every decade? I mean, they don't last very long because of the centralized mismanagement. And Bitcoin and gold, these are credibly neutral. Bitcoin's a credibly neutral network. It's not controlled by a government, a company. There's no CEO. And so you can't compete with that when you are so conflicted as a government issuing a currency. People are not going to build on top of your cryptocurrency platform because just like Zynga built on top of Facebook, and then Facebook said, "Hey, we're pulling the plug. We're going to compete with you or copy you or buy you." And so it comes down to one decision maker. Bitcoin, there's no such thing. So people are going to build on networks like Bitcoin and Ethereum, and there's no way even a very reputable government can't compete with the native currencies of those networks. Just like gold, no one controls gold. That's why gold's been here for multi-millennia, and government currencies come and go and are actually like very young and unproven when you look at the history of money.
So there have been several questions from the audience. We highlighted how Federal Reserve monetary stimulus, how fiscal stimulus like that has been and is being authorized via federal bills has been causing accentuating the kind of institutional adoption, the shift into Bitcoin, people seeking Bitcoin as a potential hedge for inflation, whether they see inflation appearing in consumer prices or in asset prices. Now, again, going back to the last, following the 2008 crisis, we had the introduction of quantitative easing in the United States. We saw a similar surge in asset prices. I actually had the pleasure recently of interviewing Dr. Ben Bernanke, and we talked about when he made the announcement in 2013 that the Fed was maybe thinking about slowing down its asset purchasing program and tapering. And then we had immediately a significant response in financial markets. We saw treasury yields shoot up. We saw a huge knock-on effect in emerging markets, which saw their cost of debt balloon. This is something that a lot of people in this audience have highlighted as a potential concern when the Federal Reserve eventually stops quantitative easing programs and starts to revert to what some might refer to as normalized macroeconomic policy. Now, Fred, is that something that you see as a potential cause of correction in the price of Bitcoin in the future, or would the continued institutional adoption be something that might transcend that?
Exactly. I think it may be the exact opposite, right, Zach? I think, you know, everybody's very sensitive right now. And, you know, as you talk about the inflationary impact on everything, it's going to have an impact on everything. The beauty about Bitcoin, again, is you have continuing skyrocketing demand. And again, we don't have to be at the London School of Economics PhD grad to know that stable supply or flat supply and skyrocketing demand is going to end up in an increasing price. So I've always told people when they say, when is Bitcoin going to correct? I said, short-term technicals, forget it. Nobody knows. But long-term, when the demand for Bitcoin starts to decline, then you can expect the price of Bitcoin to start to decline. Now, the use of the Bitcoin blockchain as Tyler was saying, as an internet protocol, it's kind of like saying live streaming is going to start declining, or the use of voice over internet protocols are going to start declining, or people will stop using email forever or text messaging. It's not going to happen. This is a generational movement into the secure internet, which again is the bottom line of what Bitcoin is. It's the internet 2.0. It's the secure movement of ownership, value, title, and money, and it's not going away. And I think we've got a very long-term run up ahead of us just by the basic economics. And I'm not sure the central banks can derail it.
So I think another point to highlight, we talked briefly about some major policy changes at the Fed, and I would navigate everybody in this session to a speech that Jerome Powell gave on August 27th of 2020, where he announced a major shift in the Fed's policy framework as part of their policy review. The first was, and the most impactful and the most recognized, was the Fed's implementation of something that Dr. Ben Bernanke had been advocating for a long time that I mentioned earlier, which is the flexible average inflation targeting regime, which allows the Fed to allow inflation to run up beyond the 2% limit that used to be the case for extended periods, as long as it seeks an average inflation target around that number in order to fulfill short-term policy goals. Another very important, almost as important aspect of that announcement, although it went much less noticed in the financial media, was the Fed's apparent abandonment of the NAIRU. Now, when people refer to the taper tantrum and some of the Fed's policy actions over the period preceding the most recent crisis, before, again, the Fed started throwing haymakers again, a lot of the interest rate increases that took place were not because of an overheating market or concerns about inflation, but because of something called the non-accelerating inflation rate of the non-accelerating inflation rate of unemployment, I think is the term, the NAIRU, which basically was this magic number, I think, of 3.5%, where they said, below 3.5%, for some reason, there's going to be inflation, and we better increase interest rates when unemployment hits those levels. Now, again, I don't want to give people a lecture, but that was the reason, a large part of the driving force behind the Fed dialing back monetary policy and monetary stimulus earlier than it would have otherwise, that drove a lot of the taper tantrum and asset price correction. With the NAIRU no longer part of the policy framework, I doubt that we're going to see a similar situation to what we saw in 2013 with the taper tantrum. I mean, Tyler, is that something that you would generally agree with? How do you think about the kind of Fed, the future? Looking out 2-3 years when this stimulus starts to unwind, do you see that potentially causing a major correction in the price of Bitcoin?
I wouldn't hold my breath in terms of the Fed stopping printing money. I think we saw in 2008 the money printing happened to get us out of that sort of tailspin crisis, but it just kept going for the next decade. In one of the greatest bull runs, maybe the longest and greatest bull run in U.S. economic history. So I think all bets are off in terms of like the money printing, and like you said, there's these theories like MMT coming in and QE and infinity, and some people think that we can just keep printing. But I think you also have to step back and look at Bitcoin as the most significant technological movement since the internet itself. Ethereum I'd put in that category as well, and back in the early days of the internet, you couldn't, it was hard to buy a piece of the internet. You had to like buy a company on top of it. You couldn't really buy a piece of the protocol. You could kind of domain squat, get a good 3-letter word or something and try and flip it to a company who wanted that domain, like let's say wish.com or whatnot. But this is different. Like I said, Bitcoin is money is the greatest social network of all. And Bitcoin and Ethereum are incredible money social networks. And you can index the entire ecosystem, everything built on top of Ethereum, DeFi, NFTs that's happening by owning the M1 base layer native currency of the Ethereum network, which is Ether, or of the Bitcoin network, which is Bitcoin. So it is interesting to look across at what's the Fed doing, how's it affecting the price of Bitcoin or Ether today, tomorrow, or whatnot, and it certainly does. But I would zoom out a little bit bigger and say, hey, this is a once in a quarter century type breakthrough, technological breakthrough, like the advent of the early internet. Are you going to sit on the sidelines and watch this unfold? Or are you going to educate yourself and put some skin in the game? To me, it's always been crazy to sit on the sidelines. When you dig into the technology, when you see that money, it's the first money that's ever been purpose-built for the internet. This is internet gold, internet oil, Ethereum being digital oil. It's so obvious. And going to sort of like the regulatory issues is that the legal question in most jurisdictions is Bitcoin or Ether going to be legal or illegal? Like that's a closed. It's no longer an open question in the U.S., Canada, UK, Europe, Singapore. The legality is there, and it's not rolling back. And this is questions that were asked and answered over 5 years ago. So do you want to be a part of the greatest technological revolution and movement in money since the internet itself, or do you not? And I want to be a part of it. I've looked at the technology. I've talked to people a lot smarter than me. I don't see how this doesn't work. I've never understood how it wouldn't work. To shut down Bitcoin is to effectively shut down the internet. You have to become North Korea and snip the internet cables. And then you don't get the FANG companies. You don't get all this other innovations. So governments, smart governments, good governments, the governments you care about and the jurisdictions you care about in the world are working and embracing this technology and ushering in this innovation. So I think it's really important to sort of see how unique and special the breakthrough was of Bitcoin that Satoshi Nakamoto gave to the world by solving the Byzantine generals problem, and ultimately how much this is going to re-architect the centralized internet as we know it, and also Wall Street as we know it, into decentralized infrastructure and networks like Bitcoin and Ether. So I really encourage people to do the work, study, and look at the big picture, because it's the chance of a lifetime, I think.
Well, I can't think of a better way to end this webinar. It's already been an hour. We had so many questions from the audience, 42 questions that I wasn't able to address. I was only able to get to a handful. Everyone who's submitted questions, we'll do our best to follow up directly. The AIM Summit team and several people behind the scenes will try to answer some of the questions that you've asked. I would like to thank you guys both so much. Tyler, such a pleasure having you. Great to hear about Gemini. Wishing also Cameron his best. I understand he couldn't make the webinar because he's recovering from surgery. So our thoughts are definitely with him and hope he's recovering very well. Fred, again, such a pleasure to have you this week. Pleasure to also be working with you on your strategic expansion into the GCC region. Thank you for sponsoring this session. Next week, we are going to be having another webinar focused again on Bitcoin and beyond. That's going to be on Wednesday, the 5th of May at 4 p.m. GST. That's also going to be in collaboration with 3IQ, and we're going to be hosting Jack Tatar, who's a specialist in the space. Again, remember, if you're joining us on YouTube for this session, please like the video, subscribe to the YouTube channel, go to aimsummit.com to be part of the live sessions, part of the Q&A, interacting with us and our speakers. Thank you all so much for dialing into this session. It was a pleasure having you all.